For each of my portfolios, I like to have a security in it that acts as a fiscal metronome. It's in the class of thing that provides steady income, preferably on a monthly basis, but quarterly is okay too. It's something that needs to be an income engine. And if it also provides capital appreciation, so much the better. But capital appreciation is not my reason for buying it. As a matter of fact, I'm perfectly happy to buy something for this role whose price remains flat for the entire duration I have it, as long as it's generating the expected steady income. The one caveat I have to this rule is that I would like its price to appreciate enough to match or exceed the rate of inflation. That way, I at least get to break even on holding it when and if I sell it, based on the share price alone. This means all of my gravy is free, and I don't lose anything just for holding on to my meat. Of course, there is a case to be made for lost opportunity cost or acquiring more growth-focused assets. But again, that's not my purpose for whatever I put in this particular role. I used to have JEPI in this spot, and it did do a pretty good job for me. I liquidated the JEPI position about 5 months ago, though, for a couple of reasons. Number one, I was having too much trouble fully understanding how JEPI operated. I just didn't know how it worked. It was too complex for me to fully grasp. But at some point, I'll study up on it and revisit it. I'll probably do a how JEPI works, kind of like I did for SCHD. And number two, I hate paying fees, even the ones that are reasonable. And I thought I could find something that could fill JEPI's income generator role and deliver close to the same return without the fees or complexity. Even though I have Realty Income as a holding, it's not the primary stock I want for this particular role. Instead, I've chosen ARC, ARCC, Ares Capital. I've had my eye on it for several years, and although this is not a full breakdown, I have several considerations for this decision. Number one, it's the world's largest BDC, business development company. There is security and stability in well-constructed, diversified fiscal mass. Currently, there are over 600 companies contained in ARC's portfolio. Number two, it's traded flat for most of its life. Since 2006, it's had 2 significant dips below its norm, with none lasting more than 2 years from start to full recovery. But since its 2004 inception, it's consistently traded mostly between $15 and $20. And I don't expect it to deviate much from that range. Now, I can imagine what you're thinking. Most people say, hey, I want to buy a stock and see it skyrocket up. And I'm literally saying I'm buying something because it's steady. Well, I'm buying this stock for a very specific purpose within my portfolio, and I'm okay with that range. Number three, recently the CAGR has flatlined, and I expect it to languish longer due to ARC's sensitivity to interest rates. But its forward dividend yield of nearly 11% is pretty high and relatively steady. ARC temporarily reduced its dividend in 2008 for 4 years during the financial crisis, but it has never cut it out completely. I like that. Number four, its debt to equity ratio is increasing, but is well below ARC's internal cap of 1.25x and relatively close to its 10-year median of 1.05x. And finally, number five, depending on which model you use, ARC is 17 to 23% undervalued. That provides some cushion for me as a recent investor. Plus, recent insider purchasing buys are supplemental positive indicators for me.
It's the latest sign that the private credit world could be facing a reckoning. Joining us now is Dan Rasmussen. He is founder and portfolio manager at Verdad Advisors. Dan, it's good to have you on here. It's, in the months that we've been talking about this issue as it's flared up, you can find folks that say, look, this is the front edge of a systemic credit issue the market's going to have to deal with, all the way to the other end saying it's just a little bit of a liquidity mismatch, just kind of a logjam of some people who want out of a good asset class. Where do you come in?
This is the start of a big crisis. Rapid growth in lending never ends well. The private credit market was the darling of investors for about 15 years, about $2 trillion or so of new inflows, all went into very risky lending. This lending was generally done at 500 basis points spread over SOFR. And it was done to companies, primarily leveraged buyouts that were taking on 5-6 turns of EBITDA in terms of debt. Those are single B rated securities. Single B rated securities have a 20% 5-year default rate according to Moody's. Remember, liquidity flowing in concealed all these problems on the way up. But now that liquidity is flowing out, we're going to see who's swimming naked.
So yeah, I got a few risks here for sure, but I'm confident in this stock for the theoretical reasons I'm buying it. My biggest concern is the stalled dividend growth rate, which, left unchanged, will eventually limit future payouts, causing me to rotate out of the holding. But as I tend to think in 3, 5, and 10-year blocks of time, ARC has the latitude to establish a place in my portfolio. Also, I consider it a quality company with solid fundamentals, excellent management, and an intelligent approach to their business. My plan is to start a solid seed position on it and let it mostly organically build itself from there by reinvesting its dividends. I chose a seed position of $15,000 for ARC and executed on it a couple of weeks ago. Since my cost basis per share is $17.77, I'll continue to dollar cost average into it. If it dips or crashes, who knows in this market? We've got a lot going on. And I'll also keep dollar cost averaging in if it rises, at least until it gets all the way up to around the fair market value. At that point, I'll adhere to the established method I use in all of my portfolios, where as any holding starts to approach its fair market value, I'll just stop the dollar cost averaging into it. If it pays a dividend and the price continues to appreciate much beyond that, I'll kill the dividend reinvestment and divert that liquid also into something that's a good stock, but that has a suppressed price, or is a core holding that doesn't pay a dividend, but is also at a fair price. The bottom line is I want to be buying my stuff at a fair price. This is one of the things I'm doing right now, and I'm interested in hearing the details on how other people construct their portfolios, especially when it comes to securities that were added to satisfy a specific role in those portfolios. Good luck on constructing your optimal portfolio, and thanks for watching.